Hi guys, welcome to TCM Education and our highly acclaimed series DTE, which stands for Day Trading Explained. And this will be hopefully Day Traders Launchpad, a 14-step or 14 episodes to your first trade. Although it's built for beginners and we are really attuned to beginners, I hope not only beginners will draw a satisfaction for watching this series, and not only satisfaction but get confidence, go back on the saddle, start trading and see this is a possible doable profession that needs to be refined, and I hope we're gonna push you in that direction with this series. Without further ado, let's see the big 10 trades that we are actually going to during this series. Let's start with number 10. So number 10, NBIS. Let's draw immediately the lines here. This is the trade. You can see the entry here at 53. You can see the stop loss at 53.50. The stock drops immediately, not immediately, in 45 minutes, $3, which is 6%, turns around higher, creates a potential additional entry, drops back to the lows of the day, which are $50, and then closes just about $50 for a big 6% win. Again, when we talk about winning, we're not going to talk about money. That can be a $50,000 position, or a $5,000 position, or a $3,000 position, or a $200,000 position. That's your solely decision as a trader. So that's number 10. Let's move on to number 9. Okay guys, number 9, Nike earnings, huge gap up of nearly 10%. Investors are happy with the results. The stock breaks early in the morning the 70, which cannot be, I mean, you cannot find a rounder number in Nike other than 70. So the stock breaks this round number with huge volume. You can see the volume here at the bottom of the screen. You can see the timing, you can see the date, you can see everything, and the stock moves up $2, then pulls back, and then moves up another $2, and the high of the day is obviously 84. Now, where do you exit this trade, assuming you entered at 70 and you didn't exit on the first pullback? A reasonable exit will be the 73 support. Obviously it breaks the 73 support, and that's a reasonable $3 winner. So a $3 winner on a $70 stock, not amazing, okay, not amazing. Let's call it 5% winner. It's actually a little bit less than 4.5% winner. So you bought a position of $10,000, that's $450. You bought a position of $100,000, that's $4,500. It doesn't matter how big the position is, the liquidity is there. No reason not to take this trade if you are a day trader. Let's move to number 8. So a surprise symbol at number 8, that's Nvidia. 99% of the time we see this stock on the winning column. On that day, which was July 1st, something happened. There was a mini sell-off in semiconductors. The stock created a beautiful bear flag above the 156 area. Remember, we're talking about round numbers again and again. The risk on this trade, not 1%, not 2%, 1/3 of 1%. So the risk on this trade was anywhere between 156 and 156.50. By any means, it's a 1/3 of 1%. So you buy, or in this case short, a position of $10,000, which is roughly 65 or 70 shares in this stock. So you risk, yes, you risk 1/3 of 1%, meaning $33. And the stock drops down to under 152. So that's from 156 to 152. That's a $4 move. Let's round things up to around 3%, and actually it's less than 3%, 2.5%. And again, if you invested $10,000, that's that's 250, and the ability to scale in this trade is immense. I mean, this is the most traded stock in the Nasdaq, and overall I think in the whole best volumes on Wall Street. So, and the best stock to trade in either direction in terms of liquidity. So that's number 8. Let's move to number 7. Okay, guys, number 7, and many of you will ask, why is this stock even on the list? But we want to show that even a $10 stock on a given day can move up a lot, and this is Thursday. So this move of from 10 to 1070 at one point, that's 7%, can happen on any stock in a given time. Actually, in this case, in a very short period of time, the liquidity is perfect. The stock traded on that particular day 33 million shares in half a day. So getting on board at 10 with 100 shares, 1,000 shares, it doesn't matter how many shares, because again, we're looking at the ability to buy without paying commissions. The stop loss is posted here at 985, so that's a 15% risk versus the average 1% risk. But again, 15 cents, which is obviously 1.5%, my mistake, versus the 1% normal risk. So you invest $10,000, you risk $150. You invest $100,000, you risk $1,500. The result is a move to 1070 and a reasonable exit at 1050, either on a pullback or either at the close of the day. And this is 3 to 1, not bad. So 15 cents risk, more than 45, which is the 3 to 1. Let's move further to number 6. Okay, guys, so why is SCDG at number 6? First of all, it closed at the highs of the day. Then the technical patterns was flawless. You can see the move up and down and up and down, and then up again and down again and up again. So every pullback was basically a buying opportunity, and this is very helpful when you're chasing a stock that's moving up and it doesn't pull back. You're buying very expensive. On a pullback, you have the time to buy and you have a tight stop loss. You can see on both pullbacks the risk is less than 1%. So if you buy at $25.50 and you close at $27.50, that's $2. That's 7% here. And if you take the late entry at $26.50, it's still $26.50. It's still a good trade. I mean, it looks very extended, but keep in mind we traded on Thursday for 3.5 hours. I mean, imagine this stock continuing another, I don't know, $2 on a normal trading day. Okay, so that's number 6. Let's move to number 5. So why is Datadog at number 5? First of all, because Datadog is trading after a huge gap up. That's a 10% gap up, easily to observe. So it immediately pops on everybody's screen. Again, now what do? How you treat a $150 stock? Exactly like you treat a $15 stock. You buy the same position, the number of shares will be down by a factor of 10. So if you buy, for example, 100 shares of Datadog, you'll buy 1,000 shares of a $15 position. Anyway, you decide. You want to buy $5,000, $10,000, $50,000, any reasonable entry in terms of money, according to your account and your risk assessments. So if you like more risk, you buy more. If you have a big account, you buy more. You have a smaller account, you buy less. You want to use leverage. There are so many factors here, but that's nothing that we need to worry about. That's your trader, your decision, and it should be made way before you started the trading day. So now you can see the technicalities are amazing. Take a look. Entry at the green line, pullback, and then the stop loss can move to the red line, another move up, another pullback, another. So again, you can see here the consistency, the trade, the pullbacks, the close at the highs. I mean, that's only 3.5 hours of work in this stock. So overall, it moves from 149 to 155 at the close. That's $6. Again, not a percentage-wise, it's not a big number, but compare it to the risk. The risk was 2/3 of 1%, which is $1, and the result is $6. So that's 6 to 1 in terms of risk reward. So if you risk $100, $600. You risk 200, 1200, and so on and so forth. It's true that from time to time we get complaints, and you know, it's tough to trade those $150 stock. You need to get used to it. Definitely, it's a shame to give up on such a trade because the stock looks expensive. That's not an excuse. Now let's go to number 4. Okay, guys, number 4, applied optoelectronics. Probably most of us, if not all of us, never heard about this stock. So what's so special about it? Well, nothing other than the stock delivers in a 1 hour move 10% intraday. So what do you want more as a day trader than a stock that moves in an hour? Basically, let's see the timing. So it broke at 10:30, and at less than an hour, 50 minutes, the stock delivers the 10% intraday and then loses this whole 10%. That's on one hand a day trader's dream. On the other hand, a day trader's nightmare, because if you wait for more upside, you don't get it. Okay, let's move to number 3. Okay, at number 3, the second best performing IPO this year, Corewave. This is a mega mover, but again, we could care less. The price is $178 per share. We don't care. We buy a $10,000 position, a $5,000 position, or a $50,000 position. It doesn't matter. The risk in this case, as you can see, is not even 1%. The risk is $1, which is 1/3 of 1%. So if you're putting to work here at $10,000, 65 or 70 shares, the risk won't be $100. It will be less. But let's include slippage and some spreads, and so it's a 1% risk, and the stock closes at the highs with a 5% winner. So again, this is the power of a great stock on the daily, on the intraday. Investors are hovering all above it. Number 2. Why is Rigetti Computing at number 2? Because it's the easiest trade. Hold on a second. Okay, now you can see it. Sorry about that. It's the easiest trade that a day trader could wish for. So the stock starts moving higher in the morning. Let's follow up. Moving higher in the morning, creates a high, pulls back, another high, then another pullback, and then creates a consolidation above the VWAP, and this is a 10 cent consolidation, which is less than 1%. And it ends up closing the trading day, guess what? At this level. So up 8% on a 1% risk. I mean, and you have so much time to assess the trade. Enter. You want to enter with any amount of shares you can. I mean, this is and you can see the increased volume exactly on the move, exactly on this move. Perfect. Now let's go to number 1. Okay, guys, our number 1. Actually, we have 2 number 1s, but being that one is fake, we're gonna need more time, so we'll close this video and we'll start a fresh one and devote like 5 minutes to our 2 number 1 plays. Back in a bit.